All right, everyone, welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street for Main Street. If you're not done so already, give the video a thumbs up, like, comment, subscribe to the channel. Come find Jason on Patreon, or come find me on carnivoretrades.com for swing trading alerts and analysis. Anyways, let's get into it. So a choppy week here for the markets. See the S&P really sideways all week, with the exception of the gap up we had on Tuesday. And then on Friday, futures were they were pretty much beat red. We'll flip over to the ES so you can see here in the overnight, we were down quite a bit and market was selling off. And I actually tweeted out Thursday night, I said, I wonder what the news will be that's going to flip the market green. And if sure enough, right around 9 a.m., just before the market opened at 9:30 Eastern time, Wall Street Journal published a little clipping. By the way, the Wall Street Journal is kind of a mouthpiece for the Fed to a degree. But conveniently, this clipping came out right at 9 a.m. when the futures were, getting pretty beaten down. You can see here they're at the lows, and we got a huge bid, basically saying that the Fed plans to hike by 75 basis points in November, and then after that, they are going to quote unquote pause or pivot, something of that nature. Now, I say this is conveniently placed. Not only because they prompt the market up, but the reasoning, we had $1.8 trillion in monthly options expiring on Friday afternoon for the monthly OPEX. It's no secret there was a lot of puts being bought in the month of October and in late September. Market makers don't want to pay those out. They want the market to go up and make those puts expire worthless. So that's really the name of the game here. And bottom line is, market liked it here in the near term. And I think there's probably a little bit more upside here for the spiders and for the NASDAQ. You can see the NASDAQ via the triple Qs here. Had a little bit of a trend line breakout there. So that trend line goes back to August. We got a little bit of a breakout there on Friday. Near term, you think you can definitely get up to that 280 gap fill, maybe even to these kind of like high pivots up here on 283. Max move would be, to me, around 290. So that's going to be this down sloping trend line that we've, pierced once, but, it ended up holding again on the back test. And then it also coincides with that pivot low. So that would be major resistance here. I don't see a lot of upside, quite frankly. You could make a case that you kind of triggered. I'll just throw this on here. You could make a case you triggered a head and, that's the wrong one. Sorry about that. So you can make a case that you triggered an inverse head and shoulders. It's a small one, but it does work. You can make a case you triggered that on Friday. The problem is, and this doesn't really change anything, you got to look at the weekly. So you got a weekly inside bar here on the spiders. You look at the diamond here, the Dow, that's inside bear chop, and then the IWM as well. That's an inside bar bear flag, a textbook one at that. The triple Qs is a little bit messier. This is still in weak technical positioning, but so you have maybe a daily inverse head and shoulders, but it's a little bit more likely to fail with that weekly, more dominant pattern there overarching. So again, I think there's probably a little bit more upside maybe early into next week, and then really this 378 to 390 area is a huge risk zone, if you ask me. So I don't really think anything's changed here. Near term, you can get a bid, but I don't think it'll last all that long. That said, market near term, it's looking for relief, and it really got it on Friday with that news clipping. Shorts got squeezed a little bit, but this is not over. Listen, the Fed pause pivot, to me, it's neither of those things, but they're just trying to buy time here because the Fed can't really fully pivot right now. And let me explain that. If we look at the 2-year yield versus the Fed funds rate, just historically, this is where they need to go. So this is the 2-year yield here, and the orange line is the Fed funds. They have to get within 10 to 15% of that 2-year yield. And when they do that, then they can stop. But they're still, if you take a look at this, the 2-year yield's at we'll just call it 4.5. The effective Fed funds rate right now is 2.55%. So they're still 200 basis points away. So the Fed is still, effectively screwed right now. And I think they're just trying to buy time. They tried to get the treasuries a little bit of a bid. If we flip back over here, we can look at the 2-year. The 2-year had a nice surge on Friday with pretty good volume behind it. It still hasn't done any technical changes. You're still in a downtrend. You haven't negated any of these resistance zones yet, but it got a bid. The yield curve on 2s and 10s did come back into 25.5 basis points inversion, still way inverted, by the way. But I think it's just the Fed buying time and maybe trying to get the 2-year lower so that they can pause. But overall, the market's looking for this like reversal to QE, and it's really not going to happen. And I think once the market really realizes that, that's where you're going to see a lot more volatility here. But for the meantime, market's holding up. We'll give it the upside bias, at least for the beginning of next week. So we talked about some of those. Talked about the indices. Let's take a look at I want to show you the Dow transports as well. So this is also a weekly. We talk about the transports every week, but you do have a weekly inside bar there as well, and that is a clean pattern if I've ever seen one. So Dow transport's not in good shape here. Semiconductors, which we always cover, again, getting a bounce off the lows. You basically just got to close a hair above that 20 moving average. Could it trade up to the gap window around 195 or even gap fill at 200? Yeah, it's possible, but I don't see a whole lot more upside right now at the moment. But again, everything got a little bit of a relief bid on Friday. Cloud software here as well. Again, you got some resistance zones coming up, 266 there, that old trend line, and then of course this head and shoulder neckline. If you get above that, that will be resistance as well. So again, there is some upside here, but not a whole lot, if you ask me, on these indices and these sectors. So we're coming into another risk period here, but short term the market can hold up. Let's flip over to interest rates. So we kind of talked about the 2-year already. 10-year getting a little bit of reversal off of that news, obviously, and we talked about the 210 spread coming in. But I mean, this is still in a very strong uptrend. Same thing with the 30-year. Gapping higher, that's a massive gap there. That probably does come in here. But again, this is strong right now, and this has been, I mean, look at HYG here on the year. And this has been a lot of these bond fund managers are kind of like scratching their heads right now. They're, I talked about this in the interview I did yesterday with Chartman Dan. A lot of people correctly predicted risk off this year, and they're still getting crushed. I mean, this environment is unlike anything a lot of us have seen. And I mean, this is just, it's a wild market here, and you've really got to be careful in this environment. I mean, the traditional risk off kind of play, just jump to treasuries, is not working. And it's been, I mean, the 2-year yield was at what, less than 1% in the beginning of 2021, and it's at 4.45. I mean, it's pretty ridiculous here, the types of move we're seeing. There hasn't been a lot of safe spaces. We talked last week. There's been a couple of things, some biotech names, Amgen, you've got, McKesson, UNH has held up. Some of the pipeline names, Kinder Morgan, this is actually green for the year. Energy Transfers, this is actually having a pretty nice year here in a down market. That's up, a good 30% or so. But, overall, it's just been a tough environment here. And really, again, going back to that 2-year Fed funds rate, the Fed can't realistically do anything right now. And that's the reality of it. Until the 2 years starts to really reverse, this market is still facing headwinds, if you ask me. Anyways, let's get over to, so we just talked about rates. Home builders here, again, got saved on Friday, so a stick save for them. Again, still the same kind of weekly inside bar, so red bar, all inside of that. So that is still bearish weekly chop. It did get saved on Friday, so we'll give it the benefit of the doubt for now, but this is not a good setup here. Same thing with the ITB, inside bar chop. VNQ, I got an oversold bounce here. Again, I keep saying this. The only bullish thing here is that it's so beaten down that you should get a rubber band kind of snapback rally here. But this has not gotten a good bounce off the lows. And I mean, if you just look at, the spiders, you had a nice surge on Friday and you closed near the highs of the week. And VNQ, it rallied, but it's still well off the high of the week here. So definitely still underperforming. Again, it does have a chance to get some type of an oversold reflex bounce, but it is definitely weak, and that is reflecting in real estate. Mortgage rates at 7% now, so not a good picture there. Financials here, again, continuing to bounce just like everything else. Nice bid on Friday, stalled out right at that 32.20, 32.30 area. Still have a weekly, you can make a case this is still a pretty big weekly bear base here. If you take a look, right here, you're just kind of inside of this range after a big down move. So that could also be construed as a pretty big bear base. But for now, financials holding up. They defended the lows and it got a bid with everything else. Broker dealers still kind of in this little wedge pattern here. So if that breaks to the upside, you'll logically expect it to get up to that trend line. It struggled with that 200 moving average last week, but now you know, you have put in higher lows underneath it, so it can get through that. I would give it the upside bias to that trend line there. If it breaks down, you're going right down to that 400 handle, which is somewhere I still expect it to go eventually, and I've been saying that for quite a while. But overall, broker-dealers hanging in there this week. Anyways, let's shift gears, get into crude. Not a whole lot going on in crude this week. You know, it's kind of muted, really just kind of an inside choppy week here. Again, we got rejected off that trend line. We couldn't hold the breakout. And then we broke back below the yellow trend line. And now we're just kind of hovering there. So again, support and resistance has not changed. Again, support here, you'll have some right around 70, we'll call it 78, 79. And that would be short term. And then your big level is this blue trend line here. Resistance is really this down sloping trend line and then up to 95. But really nothing's changed here on crude. I think it bottoms, personally, I think it bottoms one way or the other, probably right before the election, I would assume. They're very obviously draining the SPRs ahead of the election on purpose. I don't think that's a secret to anybody. But smart money will start to front run the fact that they're not going to do that after the election. So I think, you know, you could get a little flush here in crude. Definitely can't rule that out, but I think that will be a buying opportunity. Speaking of energy buying opportunities, I mean, take a look at XLE here. Power move this week. Really nice move. Got above the pivot from August 29th, and we're basically up into that gap window. I've been telling you guys it probably wants to go up there and fill that gap. You also have kind of a parallel line. I don't have the bottom one, so give me 1 second. I'll put it in for you so you can see what I'm looking at. But if you just take this parallel here, that lines up perfectly to there. So you have some resistance up there with that gap fill and that little trend line. So that would be kind of a good area of a pullback for XLE, but very strong this week. XOP as well. Again, got above that trend line earlier this week, and you've confirmed that now. So short-term resistance is at 155, but this is holding up really well. And then the real winner this week in the energy space, take a look at OIH. Bang, 5% on Friday. That is a big surge. Take a look at this pattern here. Big W. So you got that little W, double bottom. OIH looks good. It is into some resistance right now with this this gap window at about 280, and then the gap fill, of course, at 290-ish. But OIH, big move here. It's now, granted, it's a little overbought, but a pullback, I think, can be bought here. Again, the only thing that's keeping me out of this is if we have, and I say this a lot, but you know, if we do have another sell-off in the equity markets, you know, could everything come down at once just due to mass selling? Yes, and that's really what's keeping me away from them right now. But OIH holding up really well on the weekend. That is a nice power move. Nat gas here, I've been telling you guys for how long now? Really since we broke this level on September 16th. We got to go down to that 550 handle, maybe $5. I think nat gas is bottomed or very close to a bottom. Is there a chance you could go down here and tag this trend line? Yeah, absolutely. I mean, you know, you could get a gap down Monday. Anything can happen here. If you take a look, we draw a fib, you know, that's right into a 618 as well. So, you know, you may want to go and tag that, but this is a major level of support for nat gas, and I like this level as a tradable bottom. I am long nat gas right now, just full disclosure, but I really do like this level here for natty. There's just a ton of support, tons of factors here for nat gas. Anyways, especially going into the winter. And by the way, it gets really cold in Europe. Anyways, let's talk about CCJ, quickly cover uranium. So last week I mentioned, if we can get back above this trend line, you negate this pattern. And by the way, this was technically a head and shoulders. So here's your shoulder, head, shoulder. That's been negated on a weekly close. So that is no longer, so that's, you know, that's a failed pattern here. So I'd give CCJ maybe the upside bias back to about 25 here. Got a nice little V shape off the lows, and again, that was a knee-jerk reaction to the equity dilution. But long-term, this is probably a good thing for CCJ. So it's holding up. You negated that breakdown, so that is a positive here in the near term for CCJ. As far as ag and potash names, not really a whole lot going on. I will say, you know, DBC is, you know, we talked about the safe places. This has been one of them too. I kind of left this out, but you know, it's held up really well all year. I mean, you started the year at 20, 21, and, you know, it's green, which is a lot of things can't say that right now. But, you know, really just kind of a lot of chop here, a lot of chop shop. Same thing with Mosaic, Intrepid. We haven't talked about that much, but they've been kind of sideways here. So not really a whole lot going on, just kind of in a holding pattern. If anything changes, of course, I'll let you guys know. Moving over to the dollar index. good reversal on Friday, as you'd expect with the Fed news. It's still holding up, though. I mean, yeah, you're below the 20 moving average, but this is the real big level here. That 50 moving average, that upsloping trend line, and that 109.50 pivot, that's where I think it wants to go. I think that is a good level for the dollar to get a bounce at. But for right now, it did come back in on Friday. Still needs to be respected. I want to show you really quickly the yen. What did I tell you guys probably 4 months ago? 3-4 months ago, I said the yen's going to go to 150, and that's where it's probably going to stall out. And take a look at that reversal. BOJ doing some intervention on Friday. Did I know that they were going to do that 4 months ago? No, I just looked at the charts, told you guys about the measured move on the monthly. We have now satisfied that target. So you can see right there, and a double top as well. And you have a rising wedge here on the daily. So this is a bearish reversal pattern. And if this breaks, that could signal some downside. So I think the yen is topped out here. I think, Japan's in a lot of trouble, but the market, I think, is trying, or this whole move here is representative of the market pricing that in. And yeah, nice little reaction there off that 150 handle. And yeah, obviously BOJ intervening, that was the catalyst. Gold here, so it got a bit off a double bottom again. The news, again, was really the catalyst there. I still think there will be probably one more little washout in gold, and that's when you're going to see max hate. Because gold it's getting increasingly hated this year because, almost for the same reason, bonds, because you're thinking risk off, you're thinking inflation, and the metals aren't working, right? Once we get to that max, I think we get a flush out. And once we get to that level, you'll see max anger, and that's when I want to be buying. But I already got levels worked out. In the meantime, though, gold holding that double bottom. Short term, it could get a bit up to 1,700, but it's hanging in there for right now, so we'll just leave it at that. Silver in much better shape. I do like silver better than gold right now, believe it or not. And you have a little bearish inside bar here starting to form, and that failed on Friday. So I do like silver to move higher. I did pick up some silver this week. I like this pattern, and I'm kicking myself for not getting into more platinum. I had an order ready on Friday. I didn't think we would break out that quickly, but there it is. So nice move there on platinum. I've been telling you guys to buy dips on platinum for probably 3-4 months now, and that has been a good play so far. Platinum now in a breakout pattern here, and I think that wants to get up to that 1,000 handle before it really kind of pulls back. Lastly, copper finally getting above this trend line on a weekly close. So I would give this the upside bias to 360, the 100 moving average, and then after that 370 there on spot copper. So that is hanging in there as well. Bitcoin, not even going to go over to trading view because it's been in a trading range for a very long time. Nothing has changed here. Still weekly bear base intact. Oh yeah, so anyways, getting back to the spiders, again, I do think there's a little bit of upside here in the short term, but you're coming into a major risk zone between this 380 and 390 area on the spiders. For the triple Qs, it's that 283, 280 area and 290. So really just a 100-point difference there on both charts. But this is kind of a risk zone. I would give the market a short-term upside bias, though, with the momentum on the strong close Friday. Anyways, guys, going to wrap it up here. Come find Jason on Patreon. Come find me on carnivoretrades.com, and I'll talk to you guys all next week.